As we come into tax season, here are some tips for Canadian taxpayers. So this year, with record levels of inflation that we've experienced and the continued rising cost of living, there are some ways that you can look at to avoid overpaying on your taxes. So organizing your finances and preparing your taxes in advance will give you ample opportunity to look for tax deductions, tax credits, and other rebates or benefits that will help you lower your tax bill and keep more money in your pocket. So we as professional tax preparers often recommend that you reach out to your accountant before the end of the calendar year, so November, December, or at the very latest in January, so that we can review your situation and provide any guidance that might help you lower that tax bill before we actually get to your tax return. So tip number one, if you are considering retiring or even moving abroad, make sure that you plan for any of those potential tax changes. So you need to remember that there are tax implications if you live somewhere other than Canada. You could have obligations in that other country as well as still having obligations here in Canada. So there are special requirements if you want to avoid paying taxes in Canada when you move abroad. You can submit to the government some documentation to basically become a non-resident for tax purposes, so that you only pay taxes in the country that you end up living in. So that's quite advanced subject. So I always recommend talking to a tax professional to help work your way through that scenario if that applies to you. Is especially important for those that are retiring, because some benefits are only eligible to be paid if you're a tax resident of Canada. So you don't necessarily want to lose out on those benefits if you're spending too much time in another country. So tip number two, once you've hit 65, so between 65 and 70, if you're still working, you have the option of continuing to contribute to RSP. So once you hit 65, you can elect to stop contributing to CPP and potentially put, if you're an employee, about $4,000, a little less than $4,000 back into your pocket on not on every paycheck, but over the course of the year, every paycheck. And if you're self-employed, it would reduce your tax bill by almost $8,000. So many people don't know that once you hit 65, you can opt out of the Canada Pension Plan. And again, there are forms that you need to fill out to make this election. So of course, we recommend that you speak to your tax accountant for guidance on this particular topic. Tip number three, only spousal support payments can be claimed as a tax deduction. Child support cannot be claimed as a tax deduction. So child support payments cannot be claimed by the paying parent, the person who's paying the taxes, generally speaking. However, if the paying parent may still be eligible to claim an eligible dependent tax credit, so basically claiming one of the kids as an extra tax credit, or claiming the child as an eligible tax credit. But there are very specific parameters that need to be met in order to make that claim. And it has to do with having a written support agreement with the other parent. So I definitely recommend that you get your tax accountant involved in that conversation, whether it's a renewal or you're just going through that divorce and separation now. So have them, Alexa, dismiss, have them review that agreement with you so that you can potentially take advantage of that tax deduction. It's especially advantageous if there are two or more children in the separation picture. Lesser so if there's only one child, but if there's two or more, definitely have this conversation, because the way your agreement is written can make you eligible as the paying parent for an extra tax credit. Tip number 4, get your foreign investment information ready early. So there are tax implications when investing in US or international assets, whether it's stock, real estate, or other assets. Even just having a bank account with cash in it, so to speak, in a foreign country, could result in additional reporting requirements here in Canada. So it's very important to disclose all types of foreign assets and investments to your tax accountant so they can help you determine if you are subject to those foreign reporting requirements. If CRA finds out in the future that you were subject to these foreign reporting requirements and didn't comply with them, the penalties are very, very severe. So it's important to err on the side of caution in this particular aspect. So if you've got a condo in the US or a second house in the US, even if you're not renting it or whatnot, disclose it to your tax accountant so they can help you figure out whether or not it needs to be reported, and if it does, how it needs to be reported. Tip number 5. So it's always nice to get a tax refund in March or April every year, right? But wouldn't that money be better off in your pocket throughout the year? So say you are entitled to a $1,200 refund. Wouldn't you rather have an extra $100 a month, especially with the high cost of living and the inflation that we've been experiencing? So if you consistently get a tax refund, you can adjust the amount of taxes that come off your paycheck so that you have a little extra cash every payday. So, excuse me, just getting over a cold as well. So I personally recommend that, or I personally not recommend, advise that taxpayers, especially T4 employees, when they get to tax return time, they should be in a very small window of somewhere between owing $500 and getting $500 of a refund kind of thing. Basically, when you fall into that boat, it means that you haven't let the government use your money for free for the better part of a year or a little more than a year. So having that $4,000 refund, while it seems nice and you can pay off your credit card, it might be nicer to have $300 or $400 extra every month that you could put down towards that credit card, which has the added implications of, if you're putting that extra down towards the credit card every month, you're saving the 19.99%, 20% interest on that $300 or $400 every month as well. So again, talk to your tax accountant. They can advise how to go about working with your employer to have those tax deductions reduced so that you get a little bit more in your pocket each and every paycheck. So I hope you enjoyed this week's Tax Tips Tuesdays. Come back next week for another tip.